Commercial real estate can be a powerful investment, but it is not forgiving when the numbers are wrong. A property can look attractive on the surface, good location, decent building, promising rent, but still become a problem if leases, expenses, financing, insurance, maintenance, or tenant risk were not reviewed carefully. In this video, we'll walk through the most common pitfalls investors should avoid before buying commercial real estate, especially in a market like Sarasota and the surrounding Gulf Coast. Pitfall 1, buying based on emotion instead of numbers. A commercial property is not a trophy, it is an income-producing asset. Before you buy, the numbers have to make sense. Analyze net operating income, cap rate, cash-on-cash return, debt service, vacancy assumptions, tenant quality, and repair reserves. At DAG, we emphasize NOI, cap rate, cash flow, market analysis, due diligence, financing, and risk management when evaluating profitability. Pitfall 2, weak due diligence. The offer gets you into the deal. Due diligence tells you whether you should stay in the deal, renegotiate, or walk away. Confirm title, survey, zoning, and any environmental issues before committing. Inspect roof, HVAC, plumbing, electrical, and structural conditions with qualified professionals. Check ADA or code concerns, parking, access, and site circulation early in the process. Review leases, rent roll, and tenant estoppels carefully to understand the income stream. Estimate insurance costs, property taxes, and operating expenses as part of due diligence. Turn hidden liabilities into real numbers before closing so you're not surprised after purchase. Pitfall 3, underestimating hidden costs. Common hidden costs include CAM reconciliations, deferred maintenance, insurance premium increases, and property tax reassessment. Factor in tenant improvement obligations, leasing commissions, and potential roof or HVAC replacement. In coastal markets like Sarasota, also consider storm exposure, flood risk, and higher insurance premiums. Many deals fail not because the purchase price was too high, but because buyers did not fully understand post-purchase costs. Pitfall 4, not understanding the leases. You are often buying the income stream created by the leases, not just the building. Look at lease expiration dates, renewal options, rent escalations, and tenant responsibilities. Check assignment and termination rights, personal guarantees, and tenant improvement allowances. Single-tenant properties can go from fully occupied to fully vacant if the lease expires and the tenant leaves. Pitfall 5, overestimating rent growth or occupancy. A spreadsheet can make a bad deal look good if the assumptions are too aggressive. Use conservative vacancy assumptions and market-validated rent forecasts, especially for Sarasota submarkets like Lakewood Ranch or downtown Bradenton. Always model downside scenarios and stress test the deal against a slower lease-up, tenant loss, or higher expenses. Pitfall 6, bad financing or loan terms that strain cash flow. Understand amortization, interest rate resets, prepayment penalties, and lender-required reserves before you sign. Pitfall 7, poor location fit and tenant mix for the local market. Consider whether the property suits local demand from medical practices, professional services, or retail in Sarasota and surrounding communities. Pitfall 8, insurance and climate risk you did not price correctly. Obtain complete insurance quotes and review hurricane deductibles, windstorm coverage, and flood exposure early. Pitfall 9, buying without a clear exit strategy. Decide whether you plan to hold for cash flow, renovate and sell, or reposition the asset before you buy. In Sarasota's market, align your exit plan with demand drivers like healthcare, tourism, and regional population growth. Final takeaway, slow down, verify the numbers, and treat due diligence as the investment, not an afterthought. If you want a market-specific review or a checklist for a Sarasota area deal, contact DAG Real Estate Group for a practical, investor-focused assessment.